Hey, good afternoon, Market Rebels, and it's good to get back on track after a nice Thanksgiving. Hope everybody had a great Thanksgiving last week. And you're probably wondering, something doesn't look right here. And that's because Stu is unable to make it today. And for those of you in the Q&A know that he wasn't able to make it this afternoon, but he should be back with us next week. So for me, just flying solo today for Coach's Corner. But with that, let's go ahead and get started with our Chalk Talk. Now, for anybody who's new, Chalk Talk is a little thought question. And we'll come back at the end of it to answer it, but hopefully you should get it somewhat answered during the presentation. So the question for today is, what's the one thing that you must guess correctly to profit from an option? Now, a little hint, if you talk to most people, they'll say, well, that's easy. You got to get the stock's direction. And that's part of it, but that's by itself is not going to cut it. That's not really the best answer. So we're going to find out what that is and why what we're going to talk about here today is so important. It's something that most traders overlook, and that is volatility and the wisdom of crowds. So you've probably heard this term before about the wisdom of crowds, but I think very few people truly understand what it means. We're going to look at a really interesting Excel demo a little bit later. But then I'm going to show you how it applies to options trading and why it's so important to take this into account. So for a little background story first, remember when you are trading options, all options require at least 3 key components to profit from. We have to be correct about direction, about magnitude, and speed. Magnitude is talking about the size of the move, and speed is talking about how quickly that move occurs. And that's important because options have an expiration date. See, for shares of stock, it doesn't really matter if it's slow, medium, or fast. Obviously, we'd like it to be fast, but it doesn't have to be. So if you buy shares of stock, let's say for 100, here's our risk graph, right? We've got a straight line. So remember, these are stock prices on the horizontal. And then there's our 0. So that means if you pay 100 for the shares and you sell for 100, your profit is 0, right? If we sell for 110, we trace a line up here, we make 10. So a straight line just shows that we make dollar for dollar as it rises and we lose dollar for dollar as it falls. Now, how would that change if we bought maybe a $100 call for $5? So remember, our stock is trading at 100, and if we pay $5 for it, take a look at this. Now, the big thing that we get for buying the call is we get rid of all of this downside risk down here. We can see that the graph flattens out for all stock prices below 100 or whatever strike you happen to have. But the big thing to notice is that we've also pushed out this break-even point, which at expiration is always found by your strike price, in this example 100, plus the $5 premium is 105. So you can see that the red line crosses 0 at 100. If you buy the stock at 100, any tick up from 100, technically you're in the money, you're starting to make money. But that's not true for the 100 call because we need it to be above 105 at expiration. Now we could also have it move less than 105, but then it's got to move quickly. So now you're starting to see where this magnitude and speed is coming from. Now, depending on the way we structure our strategies and or our strikes, we can change how much magnitude and speed we need. And of course, we can change the direction. But let's say if we go to maybe a $90 call, so now it's 10 bucks in the money, trading for 10.50. All right, so it's got $10 of intrinsic value, 50 cents of extrinsic. So remember, 50 cents is really what you're paying for the option. Most people will say, oh, this is a $10.50 option. No, it's not. It's a 50-cent option. The $10 is intrinsic value, it's cash. It's got nothing to do with the option. But take a look at our black line right here. All right, so we can see our bend right there at 90. But look at how close that black line is to the red. Do you see how from the previous risk graph in blue, it's been pushed left towards the stock? That break-even point isn't a whole lot higher than the current stock price. In fact, it's 50 cents higher. We could also figure that out by taking the 90 strike plus 10.50, which is 100.50. So again, it's just 50 cents up above the current stock price. So by doing this, by buying an in-the-money option, we don't need as much of magnitude or speed. So this is one way we can control that. Now, what if we go to the out-of-the-money options? Everybody loves the out-of-the-money options because they're cheap. Everybody thinks that it's always about the amount that you paid, and if you pay a tiny bit, that you only have a tiny bit of risk. Well, the opposite is true. Risk is always about the probability of losing money. So if you buy the 115 strike, let's say for 10 cents, yeah, you can only lose 10 cents, but the probability of that happening is very large. Now look what we did compared to the blue and black line, and the red one for that matter, for the stock. We have pushed it way out here. We really need to have that stock make a fast, aggressive move. It's got to happen quickly, otherwise this is not going to be profitable. So now you can see that when you're trading the options, you have multiple dimensions. At a minimum, we have direction, magnitude, and speed. Whereas when you're trading stock, you just have direction. And that's why I often say that stock is a one-dimensional asset and options are multidimensional. Okay, so this is a little bit of a graphic visual of what it means. Now here's a little more maybe an out-of-industry example. Let's say that we have a car. All right, a car can go forward and backwards. It's one dimension. And that's very similar to stock. Stock can go up or down. It's just in one line. But you could have a great driving record, but that doesn't necessarily mean you should jump into a helicopter and expect good results. All right, why? Because the helicopter, which is similar to options, has a lot of different degrees of motion that are not in or available in a car. So with the helicopter, yes, we can also go forward and backwards. And this is where a lot of options traders say, oh, I've got this stuff down. Stock goes up and down, and options, if you think it's going up, you buy calls, or if it's going down, you buy puts. It's also up and down. That is not true. It is absolutely not true. Because not only do we have to get the direction right, but we've got these other degrees of motion to deal with. A helicopter can also go up and down. It can go side to side. It can also kind of bank or tilt left to right. It can bank front to back, and it can also pivot. See, those are all things that you can't do in a car, and that's why if you hop into a helicopter and suddenly you've got all these different degrees of motion, you're going to have a bad outcome. And that's why a lot of options traders think that the whole options trading comes down to, what do you think the stock is going to do? Is it going to be up or down? And they're done with their analysis. And they're missing the biggest, really the main part of options trading. So what is that? Well, we'll go find out. And before we do, please be sure to check us out at marketrebellion.com/get started. Lots of great materials, stuff just like this, lots of great articles and videos, absolutely free to help you get off to a real solid footing. It's important before you start trading options that you understand the fundamentals. And this is a great way to get it absolutely free. Okay, so let's take a look at a quote board, and I chose Supermicro Computer, SMCI, because it's been in the news lately for obvious reasons. But before you trade any option, doesn't matter what it is, the thing that you have to learn to train yourself as an options trader is to look over here at the volatility. Now, if you want to get fancier, we can look at the bid implied volatility or the asking price implied volatility. But at a minimum, we've got to look here. And very few people do. They look over here at the prices and they'll say, oh, this is too much for an option. That's five. This looks pretty good down here at 350. That's going about it the wrong way. We need to understand the price over here is derived by the volatility. So the question really is this volatility a good number? Not is the price a good number, is the volatility a good number? So I usually make the analogy like a point spread in a football game. Just because you're confident that your team might win doesn't mean you should go place a bet at Vegas or an online betting site. Maybe they've got a 21-point spread against your team. Well, now you're going to be better off betting against your team, statistically speaking. And yet that's exactly what traders overlook when they start trading options. They're just going, oh yeah, I think the stock is going up. That's like saying, I think my team's going to win. It's got nothing to do with what you think it's going to happen. You have to beat the spread. So you don't have that with shares of stock. Stock is just a one-dimensional asset, up or down. That's all you have to get right. We have more degrees of motion with an option, and we need to look here. All right, so I said the title of this presentation was about the wisdom of crowds. Where does that come in? Well, when we look at this number over here, too many times traders will say, oh, okay, it's 126 volatility. So what? That just means we have high option prices. They don't realize what this means. Or if I think the stock is going higher, how hard is this going to beat? And is this a good assessment? Is this a good guess? Now, also understand that when we talk about the implied volatility, there's different types of volatility. We have historic volatility. That's what's happened in the past. What we're really trying to find out as an options trader is what will the volatility be over the life of the option? Not what it's been in the past, although that certainly counts. That'll give us a good benchmark. But what is it going to be? And right now, the crowd on the whole has come up to 126%. And that's some good information. We have to say, before I think the stock is going up, what I really need to do is dig deeper and say, is this a good guess? And what I have found is that too many times traders just overlook this, they blow it off, don't even look at it at all. Or they go, okay, well, so what that it's 126%? I think it's going higher. Or I think the crowd has it wrong. All right, before you do that, and now we're getting to the real point of this presentation, this is where you have to understand the wisdom of crowds. So the wisdom of crowds is this idea that the crowd, in most cases, is going to be collectively smarter than any single person in the room. And it's kind of a hard concept. You would think that if you had one really smart person in the room, that would, the expert, that would be the person to go to. Or we want to go to the one expert on CNBC that says SMCI is going up. And traders go, oh, well, so-and-so said SMCI is going up. All right, well, really, what does that matter? We want to know what the crowd's opinion is. And why do we want to know that? And this is what we're going to find out. Now, a little demonstration that's done a lot in classes is to have a big jar of something. Usually they use like jelly beans or coins, and the students have to try to guess how many coins or jelly beans are in there or the value of the currency. So let's do that. We'll just kind of simulate it here. Let's say that we have a jar of some type of candies here, or maybe we got lots of jars, and you have to figure out what's the total in all of them. It's not an easy question, right? We're not allowed to dig in and fish around. We just have to do it visually and say, what's the answer? Well, again, do you want to ask the smartest person in the room, or do you want to ask the crowd? And again, you might say, well, gee, let me ask the store owner, let me ask the smartest person, somebody who's knowledgeable in this field, and that's probably going to be the wrong approach. You'd really rather go to the crowd under certain assumptions. So to have this effect of the wisdom of crowds, the first thing is we need diversity, and that just means a diverse set of opinions. We don't have a bunch of people who are falling into groupthink where everybody thinks SMCI is going up, and let's take a show of hands. Well, obviously, we know what the answer is going to be there. We need lots of opinions. This is also, by the way, why the markets allow people to short sell shares, right? Everybody, or at least a lot of people say, oh, that's un-American. You're betting on a company's demise. You need a diverse set of opinions. You can't have everybody in the room saying, I want to be a buyer. All right, so we have to have diversity. We have to have independence, meaning that everyone thinks differently. And the catchphrase that usually goes along with this says, you can be biased and irrational, but as long as you're independent, you won't make the group any dumber. So that's kind of the thought, or the simpler version of how to understand that. It's fine if you are way off. If you think SMCI is going to go up 100 points by the end of the week, that might be irrational, but it doesn't matter, because for every irrational person we have to the upside, we will have one to the downside. It's going to fall under a bell curve. They're just, on average, going to balance out. We also have to have decentralization, and that just simply means no influence from a central authority. We don't have somebody up on top, let's say maybe the boss, saying this is what I think, and everybody goes, well, I don't want to vote against the boss. So we all fall into this groupthink. We can't have that either. We also need some way to aggregate the information, coordinate all of it, and tally it up. And what do we do with the stock exchange? That's exactly what it does. And that's one of the reasons for having a stock exchange, is to say, what's a share of SMCI worth? I don't know. Smartest person in the room doesn't know. If you ask 100 CPAs, you're going to get 100 somewhat varied answers. So how do we come to a conclusion? Let's ask the group. So this whole idea of wisdom of crowds actually got its start way back with, believe it or not, an ox weight guessing contest. And this was from Sir Francis Galton. Name might be familiar to you. He was the one who was credited for the modern day fingerprints. He was a cousin to Charles Darwin. He did a lot of work with genetics and bell curves and things like that. And he was at this fair in 1906. And they had this ox weight guessing contest. And I think there were 800 people. Yeah, we had 800 participants. They had to pay a small fee to enter it. So you've got this big ox standing in the middle of the ring, and you get to, just like with the jelly beans, you got to look at it and try to figure out what it weighs. Now, in this group, you might have ranchers and farmers and people who are quote unquote experts, but you also have a lot of people that don't have a clue. And what he was trying to figure out is, it seemed to him that the expert should have better guesses. But he was also doing a lot of analysis on this idea of mean reversion. So he goes up to the carnival worker and says, hey, can I have these tickets when you're done? He's like, sure, kid, I've got no use for them. Here you go. So he takes these 800 tickets and he starts tallying them up. And it turns out that the median guess, now the median is the number that is halfway, it's in the middle. Half of the guesses were below that and half of the guesses were above. So it's the middlemost value. It's not influenced by extreme guesses like an average would be. So the median came up to 1207, and the ox's weight, 1198. Look at that, 9 pounds off. Now, some counts of the story talk about where they did it, where it was before and after and dressed out, and it was only a pound off. But the point is that the crowd got incredibly close. And then if you look at some of the stories, they'll talk about some of the ranchers and the farmers who were 100 pounds off, 150 pounds off. And even though their guesses might be better than any individual, they're not better than the group. And we have to say, all right, well, why is that, and what's causing that, and why does that matter to us as options traders? Good question. Let's go find out. And before we do, quick reminder, marketrebellion.com/get started. Lots of great information just like this to help you get a solid foundation with options trading. So the reason this whole idea of wisdom of the crowd works is that, again, you can be irrational, you can be biased, you could have, if you're trying to shoot for a target, let's say this is the truth, in this case the ox's weight, you could be way off here to the right. But for every person that guesses way off to the right, somebody's going to guess way off to the left. Why? Because they're independent. There's no reason to think everybody's going to be to the high side or to the low side. Some people will be way in this for a target. Some people will be up on the high side. Some people will be down low, and it doesn't matter because once we look at the average of all of these arrows, they're going to be really close to the bullseye. Now, another way to understand this, let's say if instead of asking people, just give me your best shot at the weight, what if we gave them categories? We gave them A, B, C, D, and we said it's between, whatever, 500 and 1,000 and 1,000 and 1,500, whatever. We gave them these different categories. Well, as long as we have a few people who have a reasonably good guess as to what this is, that's what's going to set the whole thing in motion. So let's say that choice B, we get 20% out here. But now if we had people that didn't know, people say, I have no clue, we should expect A, B, C, and D answers to be equally distributed. Why? Because people don't know. There's no reason that they're going to lean towards one letter or another. So if we just ask a bunch of people who don't know, we're going to get something like this, where all of the bars are roughly accounting for 25% of the votes. But if we have a small percentage of people who do know what we saw in the previous one, and we tack it onto this, what happens? Now our graph goes to this. So the reason that this bar showed up is not necessarily, this tall bar, is not necessarily because everybody knew the answer. To the contrary, it was really a handful of people on top of a bunch of people who had no clue. And that's what's making it stand out. And that's what allows us to kind of drill down in a big group of people and find out what the answer is in a lot of cases. All right, so to see this in action, let's go to an Excel spreadsheet. And let's see if I can bring it up here. There we go. And let's put this thing into action. Okay, so let me just give you a quick explanation. Here's the number to guess. So in our example, this would be like the ox's weight or the jelly beans. So I put these in red because you can type in whatever number you want. We're going to give it a standard deviation. Now down here, we have 1,000 guesses. There's 1,000 rows. So the computer is going to guess randomly according to somewhere around an average of 100,000 with a standard deviation of 20,000. Well, that's a big standard deviation. That's saying we've got that's plus or minus 60,000 most of the time, right? There's 3 standard deviations up and 3 standard deviations down. So we should be somewhere around plus or minus 60,000. That's a pretty good chunk. So what we're going to do, these are the individual guesses. So this is person 1 says, I think it's 100,698. This guy says, I think it's 89,000 something. This guy says, I think it's 106. These are, again, our jelly beans, not our ox. So this is the number of jelly beans in here. Now what this column does is it shows a running average. So this third number down here is the average of those 3. So if you take those 3, divide by 3, you get that number. If we take those 6 numbers there, 0 to 5, we get that number as an average. So it's just going to do a running total all the way down. Okay, so now we have what's called the over-under. So if let's call it the grand average, which is up here, 99,807, how far was this person off? Well, he was 891 under. I'm sorry, 891 over. How far was this person? He was 10,490 under. All right, so it's just telling us by how plus or minus how far their guess was from the truth, or from the average at least. Then we're going to, let's come over to this column. Here's the maximum guess. So that's looking at the largest number out of all 1,000. Here's the minimum guess. There's the smallest. So you can see we've already got a pretty good range. 161,000 down to 36,000. Well, that's pretty good bit off of 100,000. But look at the average. It comes up to 99,807. So if we look at, again, this guess right here, here's our over-under, was 61,000 plus over the average, over the grand average. This minimum guess, the person who had the smallest guess, was 63,000 off to the low side. Again, You can be irrational or biased, and it just doesn't matter. You can see we got roughly balanced, about 61 or 2,000 on the high side and about 63, maybe 64,000 to the low side. That's what I said before, where if we have an arrow to the right, we're going to be balanced by one to the left. So on average, those two numbers are what? Pretty close to zero off. They're on average at the target. So take a look at the average. Now that's the average of all of these guesses. And if we do that, again, 99,807, we were just 193 shy of the truth. And that's just 0.19% below. Now, here's the thing to take a look at, is right here in yellow. This is the main point of this spreadsheet. Out of all 1,000 people, only 7 people guessed better. That's 0.7%. So take a look at this black line. All right, so here's our running average over 1,000 people. So here's the wisdom of crowds in action. Notice how in the early stages, we get lots of variability because we don't have a lot of people. We could be off. But as those guesses start coming in, look at that black line. Just starts to hug right up against that red, which is our answer, which is our average, the number we're trying to guess. Look at how close that is. Now, it's way off in the early stages, but nearly dead on out here at the far right. Now, in Excel, I can hit F9, which will give us another 1,000 tries. So it's like we've got another jar of jelly beans. We're going to ask another 1,000 people. And let's see if we can find F9 here. There we go. Again, lots of variability in the early stages. Look at it out here on the far right. Here we had 3.6% of the people who guessed better. Here's another one. Look at this, 0.7%. Only 7 people out of 1,000 guessed better. So what we're saying is that if the average, if there are 162 off, this number here would have to be within 162. Let's see if we can go find one where Excel is finding these. There's not many of them. There's one. So you can see that was less than 162. They were within 48. This person was within 162. He was 71 to the high side. So that's what that's doing, is it's counting up all of those people who beat the average. But look at how small that number is. So the point of all of this, let's do a couple more. 2.5%, 0.5%. And it doesn't matter. We could say maybe do a smaller jar. Let's do 10,000 and make it a 500 standard deviation. There we go. Lots of variability in the short run. We start to tighten up in the long run. Look at that, 1.7% of the people beat it. Doesn't matter what numbers you use or what standard deviation. That's just absolutely fascinating. Wild variation in the short run, and over here we start to center on the truth. All right, so what's the point of all of this? The point is, this is the main point of this Coach's Corner, that when you are looking at volatility, that is the group consensus estimate of the options, of the volatility over the options life, the volatility of the underlying stock. And too many people shrug that off and go, oh, I think I can beat this options price because I think it's going higher. And you're going, really? In this example, 0.5% of the people guess better. And you think your guess is going to be better than that? What about this time? You think your guess is going to be better than 1.5% of the people. Here's another one. Think you're going to be better than 2.2%? Here's another try. 3.4%? 0.4%? You can see it starts to tighten up. So before you place that trade, the thing that you have to really look at is the implied volatility and compare that to historic and say, does this jive? Does this make sense based on what the stock has done in the past? And realizing that the crowd's estimate is probably pretty good. Now, that doesn't mean the crowd can't be off, just like in a football game. How many times do you see that they say, oh, there's a 7-point spread and the team blows them out by 35 points? What it means to be fairly valued is that the crowd is in always on the high side or always on the low side. But you've got to at least respect the implied volatility and realize that the crowd's estimate is probably really, really good. And before you step into that options trade, always remember that. So if you don't want to play the direction, magnitude, and speed, or maybe the magnitude and speed game, there are strategies for that. We could do maybe a stock replacement, get away from the magnitude and speed. So it doesn't really matter if there's a lot of volatility if you understand your options. And so that's really the main point that we wanted to make. So just make sure, especially for all the new traders, if you don't know what implied volatility is or how to maybe assess it or maybe get away from it, if you don't want to play the magnitude and speed game, those are things that you can certainly take up with a coach. You can call us right here at Market Rebellion, talk to somebody like Stu or Scotty, and they can definitely show you how to use this information. But for right now, make real sure that you respect the crowd's opinion, because more often than not, the chances of you or me or anybody else beating the crowd's estimate is really a long shot. And so with that, let's go back to our Chalk Talk question. So what's the one thing you must guess correctly to profit from an option? Again, most people would say, oh, you got to get the direction. I'd be willing to bet that's the answer you would get vast majority of the times. Everybody thinks it's just a cheap version of stock. That is absolutely not true. The thing that you have to get, even if you're right about the stock's direction, you have to get the volatility over the option's life. Otherwise, the rest of it is out the window. I'm sure many of you have purchased an option, were right about the direction and still lost. Didn't have the magnitude and or the speed. And that's because you didn't correctly assess volatility, or probably didn't even take it into account. So if this is new to you, make sure that you understand this before you continue trading options. And if nothing else, always understand that the crowd's assessment of that implied volatility is probably pretty good. And with that, I think that's a good place to wrap it up. I hope that gives you some things to think about, and we'll hopefully have Stu back on here for you next week and in our Q&A next week. But thanks for being here, and I hope you picked up some good stuff, and we'll see you next week on Coach's Corner.